He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
Welcome to No Stupid Questions with Susan Edmunds, the podcast that aims to answer all your money questions. I'm Susan Edmunds, RNZ's money correspondent. I'm joined today by Justin Gregory.
Hey Susan, how you doing?
We've had lots of good questions over the last week, so please keep them coming to questions@rnz.co.nz.
And our first question this time around comes from Leslie, who asks, are you able to explain how statisticians work out the average salary? She says she's never earned anything remotely close to the figures used. She says, before I retired, I was earning about $40,000, and that was because I was being paid 9 hours overtime per week. Mind you, I am female and was in a clerical position. Surely using mode would include the majority of low-paid workers rather than including the top 1 or 2% who receive salaries that most people would never have any hope of earning. Righto, Susan, can you answer that?
Yes, so I think there are a few bits to this question. Sometimes the data can vary on salaries depending on what we're including. Do we have people who aren't working and they're at all bringing down the total? Does it include self-employment? That sort of thing. Wages generally have increased in recent years, although inflation has taken some of the buying power away, as we all unfortunately know. So depending on how you measure it, the median individual income at the moment is somewhere around $80,000. I don't know when Leslie retired, but if it was 10 years ago, the median income at that point was more like $45,000 or $50,000. Now, if she was earning $40,000 now, that would be less than the minimum wage for a full-time week. That works out at about $49,000. I guess the thing with a median, though, is that some people, half people, will always earn less than it. So it's possible that you could work your whole career and never get to that median. But with regard to her question about whether we should use median, mode or mean, without telling everyone what they already know, the mean is the average, right? You add it all together, divide it by the number of people's salaries that you've put in the pot. The median is the central number where half the people earn less and half earn more, and the mode is the one that's recorded the greatest number of times. So if we use mode, it would be the salary that a lot of people record, and it could be skewed depending on the data set that you're using. So you might find the largest number of people earning the same amount were getting something like super, or you get this thing where people bunch at the tax bands, but then you might have more people earning between $70,000 and $80,000, but they're all earning weird amounts like $71,203 or something. And so they don't show up as the mode, even though they are the more usual income, if that makes sense. Does that make sense?
Yes,
that was a lot of
I think so.
Okay.
I'm glad you explained
okay.
mode. I didn't know what mode meant. So, yep, carry on.
But economists tell me they get around this by grouping incomes. They look at income distribution in buckets or ranges, and typically the median and mode of those would be roughly the same. So we do have data showing which wage brackets are most common, and that shows around 70,000, 80,000 is where most people sit. So that aligns with that median that we quote.
Our next question comes from Laurel, and she wants to know, why are New Zealand super payments taxed? Now, this is an interesting one because all benefits, including New Zealand super, they have a before-tax amount and an after-tax amount, which seems weird because they're all, you're being paid by the government and then the money's going back to the government, and what's going on?
That's right. So if you get the pension, if you live alone, you can qualify for $1,254.28 a fortnight before tax, which is about $1,076.84 after tax, depending on your tax code. I talked to Craig Rennie, who's Policy Director at the Council of Trade Unions, about this. He says it's basically just an on-paper accounting exercise, but it's important to know your before-tax pension income if you're earning other money while getting the pension or benefit, because it affects your marginal tax rate.
Essentially, people don't really pay tax. They're paid post-tax. And the government does a check swap automatically to remove the tax. So, because otherwise the government will be giving you money and then it will be taking it back off you.
Yeah, I could see that wouldn't be very efficient. But yeah, why do we bother giving that amount at all, though? Why do we say this is the before and this is the after-tax amount?
Well, for example, in terms of superannuation, it's because it's a legally calculated number. And that amount is then generated, and then the taxable liability is then generated, and you get paid on a net basis.
Okay, that makes sense. And for benefits, is it just because that's the way we do it.
Again, it's just a calculation mechanism rather than it being anything else. And so it's just simply the mechanics of the way the number is generated requires that, and then it's paid separate to that, and that is just simply for efficiency purposes rather than anything else.
So there's a few reasons there, and Shamabil Yaqub said to me as well that we shouldn't think too much about it because in New Zealand, all income is taxable and this isn't any different.
So that's the why. What about the what? What would be the impact on our economy if benefits weren't taxed?
It would mean a decent amount less tax was paid, I guess. The government's forecast it will spend $24.7 billion on NZ Super in the 25-26 year and about $25 billion on other social security and welfare. So if we assumed at the very least 10.5% tax was being taken out on that, that's about $2.6 billion on the super. But I guess the argument isn't that they shouldn't pay tax. It's more why bother coming up with the pre-tax amount for the paper calculations.
Now, we've got a question from Janina, and full disclosure, this is Janina Schwanica from RNZ's Country Life, another great RNZ podcast. You should have a listen. And here's Janina.
I read an article recently about how food was being used in advertising for clothing and other luxury goods, and I've just now seen a post advertising a Bose speaker that looks like a block of butter. I guess the question is, why is food being used to advertise fashion and luxury goods, and what does it say about the economy?
So I had a look at this and I see what Janina's talking about with Bose as a promo exercise for butter yellow speakers. I think this is a global promo, and I think we're a little unique in the amount of attention we've been paying to butter prices lately. So the connection between butter being as expensive as speakers is probably only one New Zealanders would make, but I could be wrong. I asked retail expert Chris Wilkinson about this, and he says something that's notable about Bose is that it used to be a super luxury brand and it's now become a bit more of a commodity, maybe like butter. But marketing expert Bodo Lang from Massey University says with regards to her point about food with luxury items and marketing, luxury is about three things: status, superior performance and sensory pleasure. He says food can support a product's luxury appeal on all three dimensions. Think of caviar or champagne, he says, or other rare and expensive foods and beverages. Their presence in an ad can immediately convey a sense of luxury. So food can be a powerful luxury signal. He says showing a handbag by itself is one thing, showing it accompanied by expensive food and drink heightens the audience's quality perception of the handbag and their willingness to pay, which I hadn't actually thought of when I was doing my own handbag shopping, but you never know. And he says food also has a multi-sensory appeal. It looks, smells and tastes good and can even feel and sound good. Think of the pop of a champagne cork, he says. And rather than conveying luxury only through words, advertisers use food as a visual shorthand for luxury, status and pleasure. He says with cost of living pressure becoming an issue, or being an issue still, I suppose, consumers still want to treat themselves. They may just do it in smaller doses and less frequently. So brands can lean into those affordable indulgences to keep consumers dreaming of luxury and escape. So food becomes a metaphor for quality, particularly when grander aspirations to quality, such as a luxury holiday or a new car, are out of reach.
Or more than one block of butter.
Yeah, that's right, that's right.
And staying in the Country Life zone, we have a question from Adam, who says he and his wife are share milkers and they want to buy a herd of cows. He said, Christopher Luxon said we could potentially use our KiwiSaver for cows rather than a house. So do we wait for that, or should we keep on saving more money to KiwiSaver?
We can't give personalised financial advice, of course, but this is one of the changes to KiwiSaver that has been talked about lately. It's something that National actually raised before the election, the possibility, they said at that point, of allowing farmers to use KiwiSaver to buy a first farm, herd or flock. But I have a feeling that since then the herd or flock part of that has disappeared. There was a fair amount of pushback to that idea because if you can buy things for a business in that way, why shouldn't you then be allowed to buy the same sort of things? Well, probably not cows, but buy something for your business in town. And then we get to the point where KiwiSaver is just another savings account and it's not working for its stated purpose, which is to help us save for retirement. But there is still support for that idea of people being able to withdraw to buy land. A lot of people working in farming are living in houses on those farms, which are supplied as part of their salary package. So they can't always use the KiwiSaver first home withdrawal option because when you do that, you have to live in the house that you buy. So one KiwiSaver provider told me that they were invited to consult on this by MB, but then the consultation was pulled without any explanation. So I can't tell you what to do, but if I were you, I wouldn't be hanging out for the cow buying option at the moment.
Another thing that's been on your radar lately, and it's often on this program and will be on more in the future, is KiwiSaver again, but this time as relationship property. What do we mean here?
Yes, so I was looking at a report into women's KiwiSaver outcomes, which are not that great. We tend to have lower balances, and at the moment, particularly so in those years before people become eligible for the pension. So one of the things that the report raised was that when relationships break up, one person is often left with a lot less in terms of retirement savings because maybe they've had time out of the workforce for kids, maybe they took a lower paying job to be able to do the juggle at home, that sort of thing.
Did they come up with any solutions though?
Yeah, so one of the suggestions was that KiwiSaver should automatically be split between the separating couple. Usually KiwiSaver contributions that you make during the relationship and any returns are relationship property.
We were just talking about withdrawing money. Can you actually get the money out in that situation to divide it up?
I don't think it's very easy, and sometimes you might need a court order. Usually what I hear people doing is working out how much more one person has than the other, and then they make up for it in the rest of their property division. So the person who has less in KiwiSaver might get more of the house, for example, something like that. But this report was concerned that a lot of people don't even think about KiwiSaver when they're separating their assets because it's kind of out of sight, but they do need to because it is something that should be divided.
So that brings us to the end of the episode.
Last week we asked you a question: how much money do you need to start a bank?
And the answer is, it's pretty complicated with the capital requirements, but the bare minimum you need is
30 million, so no bank starting for me anytime soon. I guess whether it's the best investment you could make with that money is up for debate, but it would be good to see some more banking competition if anyone does feel so inclined.
And our question this week is, what year did New Zealand get its own currency?
Send your answers to questions@rnz.co.nz. In the meantime, please follow us on Spotify, subscribe to us on Apple Podcasts, or keep listening to us wherever you get your podcasts. And if you could drop us a rating, that would help us reach more people who might have questions of their own. Bye for now.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. Justin Gregory is the producer. The engineer is William Saunders. Thanks to Leslie, Laurel and Janina for the questions. Thanks to Craig Rennie, me, for the answer. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.